Okay, chapter 11, dealing with calculating the cost of capital. Okay. So I wrote up a few things on the board already. Okay. But first of all, how do we calculate the cost of capital? So our cost when we want to borrow money in order to, I don't know, invest in our assets. Okay, so how much is that capital going to cost us? Well, we were going to use the WACC, which is again the weighted average cost of capital, okay, which is the average cost per dollar of capital raised. Now we can raise capital through equity, so selling common shares, preferred shares, or taking on debt. So these weights are based on the market values and not the book value. Okay. So let's go ahead, first of all, to page 316, and we can see the WACC formula. Okay. So again, you can see the weighted average here, right? So the first part is your percentage of equity times the cost of the equity. Okay. And we can figure out how much the cost of our equity is going to be depending on what formula we use. Okay. So we might use the CAPM formula. Okay. We take our risk-free rate and we add the beta times the market rate minus the risk-free rate. Okay. And you can see how they do that on page 318. Okay. Notice here the example was 80K Industries, common shares sell for $32.75. Okay. $32.75 now. Also, we have to figure out, so I'm going to use the constant growth model first of all. Okay. Now, the dividend will be $1.54 a share. So, $1.54 divided by $32.75 plus 0.6. Well, 0.6 is the growth rate, right? Because it says if 80K expects future dividends to grow by 6% a year, there's your growth rate. Okay, so you do that calculation and you get 10.7%. Okay, fine. Now we can also figure out what the cost of equity will be, okay, using the CAPM model, which is your risk-free rate, okay. So in our case, the risk-free rate is 3% plus beta is given to us. Beta is 1.3. No, beta is a measure of risk. The higher the beta, the more risky, the more volatile, okay? Now, from there, beta times the market rate, which is 9%, okay, minus the risk-free rate. Okay. So you calculate that out and you get 10.8%. So again, notice in the text, but then they just do an average because both of them were given to us, so we could average it out at 10.75. Now, is one better than the other? It depends. Usually you're not going to get enough information, okay, to do both and then average out. But in the slight chance that you do, I mean, then you could. I mean, is there really that much difference between 10.7% and 10.8%? Well, these are all estimates anyway, so probably not. Okay. Now, again, just a couple more other components that we are going to look at and how we calculate this, because for tomorrow's class, we're going to go one step further. Okay. We're going to combine everything in that weighted average cost of capital calculation. So if we're going to calculate the component cost of preferred stock or preferred shares, okay, again, we would use a constant growth model. So we'll take our dividend divided by the price of our share, okay? In this case, it would be preferred share, okay? And you can see this on page 318, okay? Now, we got to look at calculating the cost of debt. Okay. Why? Because that cost of debt has a tax factor to it. So even though we might pay $100,000 of interest, okay, well, that $100,000 is a taxable expense, okay, so we can use that as a deduction. So let's go back to page 316, okay. So it says here, for example, a firm pays a 10% coupon on $1 million of debt. So 1 million, maybe it's a bond. That's going to be $100,000 of interest. Okay. So from there, remember, that interest is tax deductible. Okay. So it's actually going to reduce our tax bill, okay, by $35,000. Okay. Well, we're going to take the 1 minus the tax rate of 35%. Okay. The after-tax cost of paying out that interest is only $65,000, okay? So let's look at this for example. Let's just say we had $1 million in profit. Or not $1 million in profit, $1 million in revenue, okay? So we have various, let's just say the only expense that we have is that interest. $900,000 is our tax bill. Well, we're really not going to have to pay 900,000. Sorry. So then 900,000 times our tax rate of 35%. Okay. I'm just going to do a quick calculation. Where's my calculator? 900,000 times 0.35 is $315,000, okay? So my income tax expense is $315, okay? As a result, we're left with 900 minus 315. $585 in after-tax profit. Okay. So again, I'm trying to show you how this relates. Okay. So notice here that interest expense was $100,000, right? That went here. So we could look at it this way. It's going to save us $35,000. Okay, having to pay that. Well, why? Because we're only paying 35% income tax on our income. Okay, so that factors into this calculation, or actually your base of $900,000. So we've always got to look at, when we're making an expense, there's we always got to look at it from an after-tax expense. Okay, so really it might have cost us $100,000. But the reality of it is, it really only cost us $65,000. Okay. All right. That should take us to page 318. Okay. Now, I just want us to do a couple questions just to get familiar with these calculations. So I've assigned problems 11.1, 11.2, and question 1. And then tomorrow we're going to get looking at the cost of preferred stock. Okay, that's on page 319. So eventually what we're going to do is we're going to add all these things together, and we're going to figure out our weighted average cost of capital. So we're slowly getting into chapter 11. It's a lot of calculations, but we should be able to figure that out and go from there. So that brings us up to slide 7. Okay. So we'll go from there. Again, try a couple questions out, and we will talk tomorrow. Have a good day.